I think I should start by expressing my thanks to those of you who are still in the room, because I think many of the participants from this morning and early afternoon may have left. But we're going to have a good, sweet, and short conversation on a key issue, which is really a very, very important constraint to private investment in infrastructure, which is really the project development. And what we thought we would do today with this CEO forum is to have folks that have a global experience on project development in their companies, that have done projects across the world, and to compare and contrast how project development has been successfully done in some other regions, and some of the lessons, if any, that we can learn and also apply here to Africa. Myself, before I took over as the CEO of Africa 50, which is now an investment platform totally focused on Africa, I was the global head for IFC Infra Ventures, which is a project development group within the World Bank Group, overseeing development in many, many countries, many regions, including Africa. So there's some differences here and there. Certainly there's some examples that we can learn from, but also within Africa there's stuff that work and that we can also apply. So with that, I think our last panelist is coming. I'm going to take a few questions from the audience, but maybe while we're getting folks to prepare their questions, Eddie, one question I have for you is really whether you feel that there are enough developers in playing in Africa. I certainly have my own view as to whether there are enough developers, but what is your view? Are there enough developers trying to build up deals here, and are these developers competing with one another, and is there a problem? Just tell us about this the shape of the industry, your thoughts.
Yeah, thanks very much, Alain. Well, I think the record is fairly straight on this. There's nothing like enough developers in Africa for any kind of projects, but particularly the ones that are most important, which are the renewable energy projects, where all the fuel is free and it's native to the country in question. So there isn't anything like enough there. And part of the reason is this constant searching for the bottom price. I mean, everybody, all my fellow speakers here have talked about, low prices. And let me be controversial and let me say, what's wrong with high prices? I mean, the cost of an unserved unit of electricity in South Africa is the only place I saw it really calculated with any accuracy and in exhaustive detail, and that was $4 to $5 per kilowatt hour. Now, that's an enormous price. At 1/3 of that, wind and solar are making sinful profits everywhere in the world. But that's what is costing the country not to have a unit served. So there's no reward. People go in for competitions when there is no need for competitions. And then you get, the lower the price, the less return, and the risk is high in Africa. We have to face that. The risk is always high. So that's just something that I think needs to be put in there, and is partially to account for the fact that we don't have enough developers. We lack capability in development, and we lack capability in policy formulation at government level. This is something that I think the West should help. Those of us who've gone through this long incubation period of building electricity systems over the last 100 years should be willing to help our colleagues here in Africa. But certainly, what's wrong with the price that rewards the early developers, and then everybody floods in to try and get a slice of that action, and then you can have your competition, and then you get your electricity systems built.
Yes, so let me just ask a follow-up question on that, which is that, in your view, do you think a model where you have a project development company, which is separate, that builds and develops projects and sells those projects to an asset owner, is this a model that could be successful in the context of Africa, in your opinion?
Oh, absolutely. I mean, if you look at the costs of capital, there's, if you like, 3 distinct types of vehicle that you need to make a project work and supply electricity. The first is the development company, right? Development, any money spent on development is entitled to a return of, let's say, between 25 and 50%. The more risk, the higher the return. Okay, so then you get your planning permission, you get your grid connection, you get your power purchase agreement, all the land is under your control, everything's hunky-dory, and you reach financial close. Now that's a completely different risk proposition there. And the initial money that's spent is only about 10% of the total money. 90% gets spent in building. And what are the returns appropriate there? Well, I would say 15 to 18% is the appropriate return there. And then you get the project built. And you sell it to a local pension fund, and I believe we have had 30 pension funds from the United States and elsewhere here in the room next door at a meeting. And I'm delighted to see that, because pension funds don't want to take any risk. They have liabilities, and they want to match their income with their liabilities. And I've heard CalPERS, who I know are here, say at a public conference that I was at in Washington, to say that we're very happy on a 5% return. So there you go, that's the full gamut of return that's expected. And so as each step of the way, you sell to the next stage, and everybody makes a return that's appropriate to the particular risk. So I hope that answers the question, Alain.
Well, you were quite clear on the range of returns expectation at different stages. But to be honest, we don't have many examples of successful development companies that are making money, at least in the continent, at least not yet. So hopefully we will find a few of them. So let me ask, actually, any question on the audience? Okay, while folks are still thinking about the questions.
Perhaps,
okay,
Alain, to add on Eddie's point, I think for ourselves as NG, so we are doing power, natural gas and services, we value the fact that although we are ready to exit and certainly not to have a majority share until the very end of the asset, we value the fact that we are a long-term investor. So yes, we are developing, but we bring our signature for managing the construction and the operation in the long term, so that an industrial actor will stay along the project and gives its technical know-how, and yes, bring in at one stage, possibly at financial close when we start construction, or possibly at COD when we start operation. We will bring some other actors that bring their own advantages, possibly in the form of a lower return expectation, but also for lower risks. So yes, indeed, that's very much a model. Although at the end, 5%, yes, why not 5%? But it has to be also consistent with the risk of the project and the signature of the off-taker. So if it's 5%, that's perfect. It might be more. I would tend to say that the bottleneck for project development in Africa is not so much the number of developers. On the decentralized part, we, the industry, have to do some progress for solar home systems and microgrids to be more profitable, more affordable for the customers. On the centralized part, we often say that there are plenty of projects. And the quick question, as Eddie said, is how much go to financial close, how much are bankable? And if they are not bankable, sometimes it's due to technical difficulties, but most of the time, I would say it's because they are not sure to have the right PPA with the right off-taker, with the right tariff for the long term. And that's not by adding new developers that you will bring more projects. I believe that at least I'm completely aware that they are not replicable models, but when you look to regulations such as the one that these very countries, South Africa, benefited, or Morocco, you find all the developers and the projects you want. There is no magic. Okay. There is a reason for that. So no, I would not say that there is a lack of developer. Of course, if there were better conditions, there might be more people. But it takes only two, I would say, Airbus and Boeing, to organize competition. Okay, everyone is welcome, but I would not say it's the key point.
All right, thank you, Bruno.
I think one to follow on Eddie's point, I think there's a long list of boxes to tick, whether it's regulatory framework, risk, etc. But I think the biggest measure in my mind is there enough cash in the system or not? Because you look at Tanzania, for example, the tariffs are not cost reflective. If the distribution company is not getting enough money, it's not paying the transmission company, the generation, and then the gas supplier. It's the same with Nigeria. They've done a great job restructuring the system, but there is not enough cash that will follow through from the end user all the way to the supplier of fuel.
That's very true. At the end of the day, there has to be enough money to repay the debt and provide the returns to investors. But I have my good friend and colleague, Amadou Hott, Vice President, Energy and Growth at the African Development Bank, who's here. Amadou, I think you had a comment or a question. You want to come in, please? The mic is coming. It's right here.
Thank you. I have actually a question, but it is related to an idea that we are trying to promote at the bank, but that will require really having the developers in particular to work with us on that. Mm-hmm. And it is related to the IPPs. Mm-hmm. We notice that often IPPs projects can be a bit expensive, the tariff for government. Some are relatively cheap, but often it's very expensive for some countries, in particular low-income countries usually. And because of that, many governments are subsidizing let's say, electricity in those countries. So we have been thinking with the new team at the bank, how can we intervene in the financing structure, in particular for renewable energy, to reduce the tariff. Mm-hmm. So we said, can we maybe set up a secondary market fund that will buy out most of the equity investors shortly after commissioning, maybe 2 or 3 years with some cash flows. But this structure will be agreed upon at financial close. So in your model for the tariff, you'll plug in that you will get out with your relatively higher IRR at the end of year 2 or 3. So you stay there maybe 5 years instead of 20 years, and you'll be bought out at that IRR. Let's say it's 17% IRR that you require. And this secondary fund will buy you out, and the secondary fund will require maybe 10% IRR, because I'll be seeding it with maybe pension funds and others who will have their money in the project only after it has been completely de-risked. Because we felt that there is no reason to lock in an IRR of north of 15, 17, sometimes 20% for 20, 25 years for the utility to pay that, right? Okay. So if I can have that, but it's part of the deal, it's mandatory, I'll buy you out, provided that the project meets certain conditions, that the power is coming out, the technology is right, you tick the right boxes. Okay. I guess a developer like, and you stay, if you're an industrial investor, the O&M stays during the life of the contract. The O&M. Because okay. O&M, we need an O&M to continue, right? Good. I guess that if you're an NG, you're gonna love that, because you can churn your money, put it in somewhere else, and you're staying as the O&M, right? But the other investors, and we felt that by doing that, actually, we can reduce the tariff roughly by 20%, our initial simulation for some renewable energy projects, and also will bring in more medium-term investors into IPP, especially those funds that have a duration, a term only of 5 to 6 years. Today they exclude it. And I wanted to have your thoughts, what you think of this idea. Would you like that, to have a PPA that is structured like that? So the government will tell you, I'll sign the PPA only if you agree to sell at end of year X to the secondary fund, who is capitalized, who has the money, who will mandatorily buy you out.
Okay, well, that's an innovative idea. Let me hear from the panel. But before you came in, Amadou, actually, Eddie was talking about the different return expectations on the value, on the development or the project life cycle. And for this fund, he was thinking about 5% or 6% return. But let me hear to react to that, but also people in the audience, because it's quite innovative. There are a number of issues in implementing such a structure, but I can see you're trying to provide an exit or a sure exit to most of the project. So, Eddie.
Yeah, well, I think Amadou made the point a lot better than I wanted to make it. And it's the same point, that you actually engage in this yield compression. So when you build a project, we said a return expectation of 15 to 18%, and Amadou said, right, 17%. So that's in that bracket. Now, if you've got an American company like CalPERS, who's a pension fund investing in America, they're very happy with the rate of return of 5%. But let's say you're the same company, CalPERS, or a local pension fund. Well, there's a lot more risk associated with that. So 10% isn't a bad number. So you actually build at 17% and you sell at 10%. Now, here's what happens with that. Let's say you invest $1 billion at 17%. Well, that's 170 million a year is what you realize. That's what the IRR means. 170 million in rough terms. Now, if you sell that to somebody who has a yield expectation of 10%, you've spent your $1 billion, you're getting 170. He just wants to get a return of 10%. So how do you do the calculation here? You divide 170 by 0.1, and you get 1.7 billion. So the man who built the plant gets a return of 700 million for his expenditure of $1 billion. Now that's not bad. That's not bad. Now you're going to argue with me about mathematics here.
No.
Actually, our idea is
not to give
pass on that saving
to the end user.
To the end user, not to the initial guy who developed. I'm telling you, from day one, he knows. From day one, he knows he'll be bought out at this IRR of 17%, but for only 5 years instead of 20 years.
It's complicated.
And I want the rest of the let's say the 15 years left, we price into the PPA the IRR of 10%, for example, which means then your tariff will go down.
Yeah,
and our calculation gives roughly around 20%.
It's complicated, but let me hear from...
Perhaps two elements. First, we are very happy to sell down at any stage. We don't intend to stay majority forever. By the way, when we bid, we already include, even when we have not sold down, we already include some possible capital gains in the future. I think there can be some imperfection on the market, and if you implement some new scheme, that will be great. I think what I like in the scheme you implement is that every investor will know what kind of risk it takes. But at the end, can that really reduce the cost for the end user? I believe the cost or the price is really the reflect of the cost, including the cost of risk. So it is, at the end, always very important that the risk is limited, that the cost can be recovered. And that's where the question of, is there enough cash in the system coming in? I am optimistic, because when you look to the telecom sector, they found the cash. When you look to solar home systems in the power sector, when people have their own choice, they find the cash. So I'm optimistic we can also find some cash for the centralized solutions, but that's very much into the way power purchase agreements are settled, and certainly a bit of financial optimization is possible, and we are happy to participate.
I think Justin from Dinan Capital had a question or maybe a reaction. A reaction, yeah. To Amadou. Justin, you want to? Oh, coffee or something.
Thank you. I think that's a great idea for certainly someone like me as a private equity fund backing developing projects all over the globe. Because one of the things as we think about our investments are what's our exit look like, and certainly in a market like generally, let's say Africa, maybe ex-South Africa, the uncertainty around what the exit looks like certainly informs our thought process around the type of return we need going in. So for me, if I'm able to solidify my exit going in, then the issue for me is more execution, and execution is what I deliver. So that takes, for me, that would take a big chunk of uncertainty out of the equation, and that would allow us, I think, to lower the tariff on our projects. And I can imagine some of the panelists who are more build and hold investors, that may not be as helpful, but certainly I would think any financial sponsor who was going to have an exit as part of their strategy would be interested in this.
But Justin, would you then give up the upside of basically the returns that Amadou wants you basically to sell the project at? It's low, but he only wants you to get the high return over, let's say, 5 years. And
well,
everything else.
There's obviously a lot of details that need to be worked out, but the concept of being able to really bake in your exit, and that's actually a very important part, in my mind, would allow us to deliver, which I think, to be honest, I disagree with you, our tariffs are low, what we're delivering, but lower tariffs from the already low tariffs that we have, at least for a sponsor like myself. Even that's what I mean, even lower. Lower.
Fair enough. Yeah. It's an interesting idea to, Kofi, you wanted to come in to explore this?
Any pension fund is in the room.
Yes, I'll ask.
No, I have a comment on a different subject altogether.
Please, go ahead.
Yeah, and it's regarding project development. And really, for me, it is a dialogue between project developers and the government most of the time. And the question as to how that dialogue happens, how it is implemented is really critical. So what we've seen is that the incentives within government haven't resulted in actions that have fostered project development. Governments have often frustrated project development to the point where many projects haven't advanced, and we've seen that all over the place. So the real question to project developers, for me, is not whether there are enough resources, whether the procurement process is perfect, but it's really how do you influence government such that government behaves in a way that is positive to project development. And as long as this is not done, we will still be frustrated and have the same conversations over and over. So questions to you, how do we get there, or what are the levers that we might have to at least move forward in that dialogue with the government such that we can develop projects more efficiently?
Yeah, that's a good question. I think we were discussing earlier before the panel with Bruno.
But I ask the question to you, as you are the one that looks more like a state, an African state.
I suppose, but I suppose I'm the moderator, though, so I'm asking the questions. I don't answer them, at least on this panel. No, that's the crux of the matter. I think that in most of situations where projects don't move forward, Eddie maybe wanted to bail me out and answer the question.
Yeah, I think it's a great question. Like what the developer has to do primarily, and what we've done in Europe through the European Wind Energy Association and the Friends of the Supergrid, which are two associations that we set up, you have to paint a vision for the government of what can happen if you've got renewable energy supplying people with electricity. And that vision can call on things like in Germany, for every 1 megawatt that was built in Germany, there was something like 9 people employed. So you begin to take off in the green direction. All the fuel that you have for wind and for solar comes from your own resources. You will never be held ransom by somebody in Saudi Arabia or anywhere else, putting the price of oil or gas up. And you've got to paint this vision for the people who are making the decisions. And you've got to keep on doing it. And you've got to you've got to spend money on this, and you've got to actually interact with them, and you've got to employ people who are good at this kind of stuff. And governments do respond to that. We found, developments in the West didn't just happen. They happened because somebody sat down and said, here's the way we see the future, and if you do this, you will, the number of jobs. President Trump in America is trying to stop green development, but he can't, because there's hundreds of thousands of jobs being created in America on that account. And we've got to make that point, and that enthusiasm has got to come through as well from the developers.
I think there's another important point that where the DFIs could play a role, where if CEC throws its weight with, let's say, the High Commissioner, DFID, or, for example, the US Embassy with OPEC behind it, it does, you know, the government will listen much more than to a single private sector player. So we see ourselves as playing quite a big role in pushing the agenda in front of the government and getting the attention required.
All right. Sorry.
Possibly
Bruno.
also another source is positive emulation. We often see that African countries, although they don't copy-paste, they look at what their neighbor are doing. And good example could spread. I think if solar home systems or microgrid in one area happen to be competitive and appreciated by the population, they could spread. I have also that there is a feeling of a buzz since IFC has launched the Scaling Up Solar. People are wondering how low the cost and the price of solar can go. Of course, solar has its limitation. It does not bring power in the night when it's most needed. So it's something to be recognized, acknowledged, and tackled. But yes, positive emulation, I think at the end, that's a good way for sovereign states to make their mind and choose the best scheme.
All right. So I agree with everything that has been said. But look, let me just add my 2 cents. I've been doing this business, project development, for many years. Again, I spent 17 years at IFC. The last 9 years, being the global head of the project development group globally in all emerging markets. And I can tell you that some of the challenges that we see here in Africa for the development businesses, we see them also in places like Vietnam, in Nepal. We lost money, IFC Infra Ventures, developing hydro assets in Vietnam, in Nepal as well. So we see them. It's about leadership in the government. That's at the end of the day what is the challenge. And if you don't have you know, a bunch of leaders, not only the president or the prime minister, but you know, across the board, people that really want to do things will be slow. So we will continue to push. But we need to make sure that maybe through positive emulations or elections or whatever, that the leaders actually start to make the right decisions. Now, in the meantime, we cannot just sit down and wait. We're going to start to do projects. And I think DFIs could help by providing political risk mitigation instruments that would de-risk the project. But those DFIs, sometimes they're too slow. They're too slow to deploy those instruments. So we need to figure out a way for those folks to be quite involved early, proactive, and deploy this instrument while we are putting the political pressure and the populations on their government to make sure that those governments are changing, because that's when things will be scaled up. That's my 2 cents. Now, I think we still have maybe 5-10 minutes for additional questions. Our friend from EIB there, maybe they have you know, some comment. Anybody else? Not Amadou. Amadou will come up with another interesting idea. But with it coming. Yeah, yes, still, Amadou wants further feedback on those.
I think one other good idea that has been floating around is local currency debt. So not a lot of institutions can provide that. I personally think that foreign currency or dollar PPAs are a huge burden on governments, and my view is that the power sector, the way we know it today, will not be the same in the next 5 to 10 years because of the dollar PPAs. So institutions like yours, if they can provide local currency local currency debt, that would help a lot in mitigating the foreign exchange risk.
And should we even talk about PPAs anymore? PPAs are stuff that you sign for 20 years. Who knows what the technology will be in 10 years, off-grid solar. Now, I think that for lenders, they will tell you, look, we need stable contracts to be able to finance them. But that's a provocative question. Should everybody continue to sign 20 years PPAs? Anybody has a strong view on that?
50 would be better. Of course, any big capital investment project, you got to have, you know, like you can get away with, if the prices are high enough, you can get away with a 15-year PPA. But, you know, in Africa, I think a 20-year PPA is quite appropriate.
Okay, that's fine.
If you can 50 years less, then you can get 50 years PPA.
Yes.
You will never get 50 years left to spread it for 50 years.
I am afraid that if you propose that after 5 years you will have a merchant price based on the spot price of solar production, the cost of capital will go sky high.
Yeah.
Yes, I agree. And lenders won't even finance you in some of these regulatory sectors, including the DFIs. They would. Yes, it's going to be challenging. That was just a provocative question.
My other piece of advice would be, if you're going to get involved in the secondary market, you want to get institutional investors involved, why not get the credit rating agencies to come and rate the project, give it a proper rating, then you can assess the IRR of the project on that basis. Because that would then give a proper weighting and give a proper credibility to the project and to the project promoter itself.
Absolutely.
Yeah.
But unfortunately, the rating of many off-takers is low.
It's very low.
And you can put it transparently, but look at off-takers, not only, by the way, in Africa. This spread between tariffs and cost happens also in Europe. You have very low rating of off-takers.
I don't think the rating is low. I think most of them are bankrupt.
Which serve to help us provide the loan from day one anyway. The guarantee is usually strong.
Okay, so you have government guarantees, but the PRGs also. But then the government guarantees also are limited these days because with the IMF program, so they're limiting government's ability to guarantee. So we need to find schemes where you don't necessarily need a strong government guarantees, but then again, you need the government to have a skin in the game, because they're responsible for the off-takers as well. They cannot just, there's no free lunch.
The discussion we've been having within the EU with Ridolfi is the fact that if we do provide off-take guarantees, there should also be a program involved in capacity building of those off-takers. So you cannot have an off-take guarantee without some sort of program where you develop, train, assist in the capacity formation of those off-takers. So you do that in a parallel way. You provide the off-take guarantee, but you also provide the capacity building to the off-taker so that they can enhance the capacity and obviously have a more acceptable credit rating.
I wonder why nobody pushed for reform and privatization of the distribution companies where the cash flows will come from, or at least concessional. Andrew, I have maybe some views on that. Would you, to make sure that if you have a conundrum, you cannot have government guarantees, but yet you have to figure out a way to finance IPPs with long-term offtakes. How do you do this?
With a micro?
With a microphone.
Thank you very much. Thank you very much, Alain. I was just having a nice, quiet time. Listen to all this. Honestly, I actually believe that technology is going to change this, and that what we're seeing in terms of particularly solar is going to have a very profound effect on the whole power market. I've been thinking about this quite a lot, and when you look at the fact that we've all been working one way or the other on power in Africa for the last 15 to 20 years, and the state-owned utilities, were not bankable then, they're not bankable now. I mean, I'm obviously generalizing, there are one or two that are. We needed guarantees then, we probably still need guarantees now, especially when you consider the pricing that needs to be done, needs to be achieved in the sort of financing versus the tariffs that people want to see coming out the other side. And we've been trying to make these things bankable one way or the other for the last 20 years, maybe longer, and it hasn't worked. And I think that, frankly, technology is going to get to a point where a lot of the customers, not all, will be able to bypass the state utilities and have their own power solutions. And I honestly think that that's what's going to happen. And so I personally wouldn't be signing a 50-year PPA or even a 20-year PPA, because I really don't think there'll be anyone buying your power in 15 or 20 years. So I don't really have a solution. They're much sharper brains than me. I don't really have a solution, for the conundrum within the current framework. But I do believe that the framework is going to change. I think people have made this parallel too far and too much, but I think there are parallels between how we tried for many years to follow a business model in telecom, and then technology came along and allowed us to follow another business model, which essentially, bypassed a lot of the state-owned utilities. I think if technology in power continues to progress, something like this is also going to happen.
That's a very profound comment, although we don't have solutions, but actually I share some of your concern on the change in the industry. So anybody wants to react to that, or anybody in the audience?
Yeah, I'd like to say something on that, because the cheapest power that you can deliver to a customer is grid-connected power. Solar can be very cheap. We bid in Chile $2.94 cents per kilowatt hour, and we didn't win a contract because the winner paid 2.91. Now that's unbelievably cheap. But what happens when the sun goes down? And when the sun goes down, the demand goes up because the sun goes down, and that's exactly when you don't supply power. So now you've got to start putting either diesel backup generation, which I personally will have nothing to do with, but you could have storage. Now storage costs between 450 and 650 per megawatt hour. That's thousands of dollars at the moment, and that multiplies the cost by about 5. So I agree with you that in the long term, when as our friend, what's his name from Tesla?
Elon Musk.
Yes, when Musk gets the price down to 100,000 per megawatt hour, then we may have a solution. It'll definitely be here by 2025, but it's not here at the moment. So the cheapest way to deliver power to the African peoples at the moment is a 20-year contract that's connected to a grid. That's the cheapest way.
I suppose that's right, because otherwise he won't be financed. And Andrew, you would agree that if somebody comes to you at AFC and saying, I have this IPP and finance me on a merchant basis, you're probably going to say, maybe not, because you need a stable... So we also have to grandfather sometimes solutions which are needed today, because this is what we have today. But I do agree that within 5 years, maybe the industry will be changed. And then, what we are saying today would be history, and there will be a new landscape. But based on today, I think we still need to deliver power on a more traditional basis, I think. Andrew, you want to react to that? Please, of course. And then we will...
Yeah, I agree with the last point. And I mean, we are still financing grid-based power, so don't get me wrong. And there is the question of the transition, and I think also it will take quite a long time before you can run, say, a cement plant off solar. So, and storage is an issue. But let me say something. I mean, today in Nigeria, I personally am thinking of going off grid. And, it may cost me money, but the fact is that, yes, the grid is far cheaper, but you only get the grid for 50% of the time, and then you still need to have a solution that's going to carry your house. That could be diesel, that could be solar. So it may not be the absolute cheapest cost, but frankly, I think not having to think about power, not having my TVs and things blow up, etc., mean that I may be willing to pay a little bit higher price. Maybe I can also afford to do that, which other people can't. But I think that the problem with technology is that inherently it's unpredictable how quickly it's going to develop. And ironically, I think it makes it harder to find. So I would, financing a sort of hydro project on a 20-year PPA, or even a gas-fired power project on a 20-year PPA, I think is a lot more doable, funnily enough, than financing a solar project. Because with a solar project, you just don't know how much the price is going to fall in the next 5 to 10 years. And if a government is paying, just to say a name, 10 cents per kilowatt hour for solar today, and they've signed up for the next 15 years, and then, in 5 years, somebody comes and offers them 3 cents, it's going to be very hard for them to continue paying you 10 cents. And that's frankly something that I think we need to build in to how we finance the projects today. So I'm not saying that we shouldn't finance the projects today. We need power today. But I think, it would be foolhardy of us not to think of where the models can develop to and what sort of risks that will bring in the future, especially if we're providing the financing on a 10, 15-year basis. If I'm providing you 5-year financing, then I don't need to think about what's going to happen to the power industry in 10 or 15 years. But if you want me to provide you 20-year financing, then I have to.
Fantastic. Fascinating debate. But unfortunately, I'm told that we need to finish up. I was not told this time by Barbara, but by somebody else who probably works for Barbara. So let me thank the panelists, and thank you again, the audience, for joining us today.
Doing business in Africa. You can't afford to be without Africa Investor.